Gold does not hit record highs because traders get emotional. Gold hits record highs when the financial system begins showing stress that official language is still trying to hide. That is what makes this moment so important. This is not a commodity rally. This is a signal, a warning, a verdict from capital itself. And most people are misreading it. They think gold rises because inflation rises, or because war breaks out, or because interest rates might fall. Those things matter, but they are not the real story. Gold rises most powerfully when trust in the management of the system starts to weaken. Gold is not just reacting to events, it is evaluating the credibility of the response. It is asking whether policymakers still look in control, whether sovereign promises still feel safe, whether the old assumptions about stability are beginning to crack. When gold breaks records, what you are seeing is not fear in its first form, it is recognition in its final form. There is a pattern behind this, and once you see it, history stops looking random. Every major monetary order follows the same sequence. First, it builds trust. Then it expands on the strength of that trust. Then it gets hit by pressures that expose how much of its stability depended on confidence rather than discipline. And finally, when that confidence weakens, money starts running toward harder stores of value. That sequence has repeated through empires, through republics, through gold-linked systems, through fiat regimes, through war finance and debt crises. Different technology, different language, same sequence, every single time. It always starts the same way. A monetary system only works when people believe there are limits somewhere. Maybe those limits are formal, like convertibility into gold. Maybe they are institutional, like a central bank with genuine credibility. Maybe they are political, like the tax capacity and military dominance of a major power. Whatever the form, the foundation is always the same thing: trust and restraint. People accept paper claims because they believe someone will stop the system before those claims become absurd. That early trust is what gives the system power. It allows borrowing, it allows expansion, it allows emergency action. And that is where the second phase begins. A trusted system starts using its credibility as fuel. Debt rises because it can. Spending rises because it can. Monetary intervention grows because it works, for a while. Crisis management becomes policy. Temporary becomes permanent. Every new expansion gets justified as necessary, manageable, and reversible. And because nothing breaks immediately, the illusion gets stronger. The system starts believing its own mythology. This is where the real danger lives. Systems rarely collapse at the moment they become reckless. They collapse after a long period in which recklessness was rewarded. Privilege delays consequences. It does not cancel them. Then comes the pressure phase. Sometimes it arrives as war, sometimes as recession, sometimes as inflation, banking stress, or rising borrowing costs. The specific trigger changes. The structural function never does. Pressure reveals whether the system still has room to maneuver. And once that room disappears, policymakers are forced into trade-offs they cannot cleanly resolve. Tighten policy and growth weakens. Ease policy and purchasing power weakens. Borrow more and debt deteriorates further. Cut spending and politics becomes unstable. Every path forward now carries visible damage. That is the critical moment. Not the headline crash, not the dramatic speech. The critical moment is when the world starts realizing that control has become conditional, that the people managing the system are no longer choosing among good options, but among expensive ones. At that point, markets start behaving differently. Investors stop asking only whether assets will go up. They begin asking whether the unit those assets are priced in can still be trusted. And then the final phase arrives. Trust leaves the promise structure. It does not always flee all at once. Sometimes it leaks slowly, sometimes it sprints, but it leaves. It leaves long-duration paper claims. It leaves currencies facing dilution. It leaves governments that need ever more borrowing just to maintain what used to be normal. And it moves toward things with harder integrity, real assets, short-duration claims, foreign currency, and above all, gold. When the question becomes monetary credibility itself, gold becomes powerful in that moment because it sits outside the political promise chain. It does not need a finance minister, a central bank press conference, or a rescue facility to exist. It is not efficient. It does not pay yield. It is not productive. But when trust in financial promises starts to thin, its indifference becomes exactly its value. History has already proven this mechanism. Look at Weimar Germany. Before the collapse, Germany was not a chaotic backwater. It was one of the most sophisticated industrial powers in Europe. It had productive capacity, institutions, engineering strength, and a functioning monetary order. That was the foundation. Then came the overextension. World War I imposed a massive strain, and rather than confronting the full cost immediately, Germany leaned heavily on debt. When the war ended, reparations crushed what recovery space remained. The state faced a problem common to every overextended system in history: obligations far beyond what the productive base could cleanly sustain. So it printed. Weak analysis stops there. They just printed too much. But that misses the deeper truth. Money printing alone does not destroy a currency. Money printing into a collapsing confidence environment is what destroys it. Once households, firms, and foreign actors understood that paper claims were multiplying faster than any believable path to stability, the currency stopped functioning as a store of value. The system did not merely suffer inflation. It suffered a social break in monetary belief. And once belief breaks, people are no longer using money as a neutral medium. They are using it as a burning object they want to pass on as quickly as possible. The end state is predictable: flight to goods, foreign currency, hard assets, gold. Anything with more integrity than the collapsing unit. Weimar matters not because it was extreme, but because it makes the mechanism impossible to miss. Now look at the United States and the breakdown of Bretton Woods. After World War II, the international system was rebuilt around a grand monetary promise. The dollar would anchor the world, and the dollar itself would remain linked to gold. This was not just a technical arrangement, it was a psychological one. America had industrial supremacy, military reach, deep reserves, and the confidence of the entire post-war order behind it. The foundation was real. Then came expansion. Reserve currency status gave the United States extraordinary room to move. It could issue liabilities the world wanted to hold. It could run deficits, finance global commitments, and still command trust. But that privilege carried a hidden contradiction. The more dollars the world demanded, the more claims accumulated relative to the hard anchor beneath them. Add the costs of Vietnam, Great Society spending, and rising external imbalances, and the gap between promise and discipline widened, quietly, for years. This is why dominant powers are often the last to admit danger. Their scale makes them look exempt. Their privilege works like painkillers in a worsening illness. It numbs the warning signs while the underlying imbalance keeps growing. By the early 1970s, foreign holders were openly questioning whether the United States could maintain gold convertibility at the official price. Then in August 1971, President Nixon suspended convertibility. Publicly, it was framed as a practical defense of national interests. Structurally, it was an admission that the original discipline could no longer survive the scale of obligations built on top of it. The system moved from constrained trust to discretionary trust. From "this paper means something because it is anchored" to "this paper means something because we say it does." Those are not the same regime. Then came the 1970s. Inflation surged. Confidence in paper savings collapsed. And gold, released from official restraint, exploded higher as the market repriced the credibility of the monetary system itself. This was not a commodity boom. It was a broad judgment on a world where the old anchor had broken and the new one had not yet earned unquestioned trust. And if you go further back to Rome, the continuity becomes almost disturbing. Rome built monetary authority on power, taxation, military order, and the integrity of its coinage. The system worked because Roman authority worked, but imperial systems always face the same temptation modern governments face: expanding commitments without imposing the full visible cost. Military burdens rise, political competition intensifies, administrative expense grows, and eventually rulers begin altering the medium itself. In Rome, that meant debasing the coinage over time. Preserve the face value, reduce the substance, keep expenditure going, delay the reckoning. It is astonishing how modern that logic feels. We flatter ourselves by imagining that digital finance is sophisticated beyond ancient comparison. But the incentive is identical. The state wants more spending capacity than clean discipline allows, so it stretches the money. Then confidence decays. Better coin gets hoarded. Worse coin circulates, merchants adjust, prices distort. The public may not write elegant treatises about monetary erosion, but people do not need formal theory to sense when official money is losing integrity. They react. They seek harder settlement. They prefer reality to proclamation. That is the final lesson of Rome. Once trust in official money weakens, society spontaneously searches for a truer standard. Now look at the present and ask whether the pattern is really so different. For years, the modern world operated on the assumption that the US-led financial system could absorb almost any shock. Global financial crisis, massive intervention, pandemic, massive intervention, banking stress, intervention, market instability, liquidity support. The system survived each episode, and because it survived, people became convinced that survival itself was proof of strength. But survival can also be proof of increasing dependence on extraordinary measures. Debt climbed globally. Sovereign obligations swelled, balance sheets expanded, policy tools once considered emergency options became normalized. Governments discovered that markets would tolerate enormous borrowing as long as confidence remained intact. Central banks discovered that their emergency role had become permanent in the public imagination, and electorates grew accustomed to rescue without fully pricing the cost. High debt is not just a large number, it is a constraint on future flexibility. It means normal interest rates become more dangerous. It means downturns become more costly to manage. It means policy error becomes harder to reverse. And it means credibility becomes more valuable because the system needs trust just to finance its own continuation. Debt on this scale is not merely an economic condition. It is a political dependency. Now the stress phase is revealing itself. Inflation is no longer something advanced economies can dismiss as a relic of the past. Geopolitical fracture is no longer a temporary disturbance. Long-duration government bonds, once treated almost automatically as perfect safety, no longer offer the same simple shelter when inflation risk, fiscal deterioration, and policy uncertainty are all sitting on top of them at the same time. And when the old hedge starts feeling less certain, the portfolio logic of an entire era begins to change. Investors start questioning assumptions they once treated as automatic. Can central banks cut aggressively if inflation remains sticky? Can governments borrow endlessly without bond markets eventually demanding a higher price? Can a reserve currency issuer maintain global trust while running chronic deficits, managing political polarization, and navigating geopolitical conflict simultaneously? These are not fringe questions anymore. They are the central questions. That is why gold matters so much right now. Gold is not responding merely to inflation, not merely to war, not merely to interest rates. It is responding to the possibility that the entire confidence architecture is getting weaker. Central banks have not been buying gold in size because they became sentimental. They have been buying because reserve diversification matters more in a fragmented world, because sanctions risk is real, because concentration risk is real, because in a world where trust is no longer frictionless, neutrality has value again. This is also why gold can look irrational to analysts trapped in narrow frameworks. They ask why gold is strong when rates are high, why gold is strong when the dollar is also strong. But those questions miss the deeper shift. Gold becomes especially powerful when markets are no longer evaluating one variable at a time. In a world of layered uncertainty, gold is not an inflation trade or a rate trade. It is a credibility trade. It rises when the market senses that too many things are under question at once. That does not mean gold moves in a straight line. It never does. Structural bull phases in gold routinely contain brutal corrections, false breakouts, sharp reversals. That volatility confuses shallow observers into thinking the larger story must have ended. But volatility is often exactly what a repricing of trust looks like. Trust is emotional. Trust is political. Trust is nonlinear. A market trying to price the future credibility of sovereign promises will never look calm for long. The deeper answer to what happens next is not gold probably goes higher. The deeper answer is that the world is entering a recognition phase. More investors will start realizing that old portfolio assumptions are less reliable than they once were. More institutions will begin treating hard assets not as backward relics, but as strategic ballast. More governments will quietly acknowledge through reserve behavior rather than speeches that neutral stores of value still matter. And more savers will discover that nominal returns and real security are not the same thing. This does not guarantee a dramatic collapse tomorrow. History does not always move through one cinematic rupture. Sometimes the adjustment is slow, frustrating, and politically disguised. Sometimes there is no single crash, only years of diminished integrity. Years in which purchasing power erodes, long-duration paper underperforms, fiscal pressure keeps building, and each new crisis requires greater intervention than the last. The pattern does not demand spectacle. It only demands consequences. This is why the phrase, "this time is different," is so dangerous. It is usually the final defense of people who understand the data but refuse the pattern. They point to technology, they point to innovation, they point to modern central banking, but none of those things repeals the underlying logic. Technology can raise productivity. It cannot erase decades of accumulated debt dependence. Modern finance can diversify risk. It cannot conjure trust once policy credibility begins to weaken. A reserve currency can delay consequences. Delay is not cancellation. The privilege of issuing the world's reserve currency can actually make the pattern more dangerous, because it permits longer expansion, larger imbalances, and greater confidence in permanent exemption. The stronger the foundation, the more tempting it becomes to exploit it. And the more thoroughly it is exploited, the more significant the eventual repricing becomes. So the real lesson is not buy gold because the chart looks good. The real lesson is to understand why gold is speaking so loudly right now. Gold is telling you that confidence in the system's managers is no longer unconditional. Gold is telling you that debt, inflation risk, policy constraints, and geopolitical uncertainty are no longer operating separately. They are interacting simultaneously. Gold is telling you that in a world where too many promises depend on too much faith, faith itself has begun to cost more. That is the signal. Watch the debt. Watch fiscal behavior. Watch central bank language. Watch long bonds. Watch reserve diversification. Watch how often reassurance replaces confidence in official communication, because reassurance is what leaders use when confidence is no longer automatic. And do not let anyone seduce you with the comforting idea that history has been abolished by software, central banking jargon, or modern branding. The same sequence keeps returning because it is rooted in human incentives. Build trust, exploit trust, face pressure, lose trust, search for harder ground. That was true in empires. It was true in industrial republics. It was true in the 20th century. And it is true now. Gold at record highs is not a random market event. It is the visible signature of a system moving into a more dangerous phase. A phase in which trust must be re-earned rather than assumed. A phase in which old hedges may not work the old way. A phase in which the market begins distinguishing between what is liquid and what is real. The safe haven rush is back not as a passing mood, but as a structural response to a world where too many supports are under question at the same time. And once that kind of recognition spreads, it rarely disappears because of one encouraging inflation print or one polished policy speech. It fades only when the system proves it can still impose discipline on itself. That is a very high bar, in a world this indebted, this politically divided, and this geopolitically tense. So no, this is not simply a story about gold. It is a story about the trust architecture of the modern world. Gold is just the part of that story that cannot hide.